Welcome back to Academic Markets Insight. I am joined today with Dr. Rowe, and we are going to be talking about a very topical conversation, private credit. So this is something that's been in the news, it's been discussed, it's been tinkered with, there's lots of excitement around it, there's lots of trepidation around it, and we're finally going to dig into what it is and what we should be looking at. So, with that, Dr. Rowe, please take us into the deep world of private credit.
And this, one of the things with respect to private credit is it's something that, I don't know how much we've mentioned this, but you and I used to be in the car for 12 hours a week together, commuting back and forth from Chicago to Kelly. And we talked about private credit an awful lot over the last 2, 3 years. We really, or the last couple of years leading
Mhm.
up to this school year. But it's not something that's been on a lot of people's radar until very, very recently. So not only is this a good discussion of the private credit market, it's actually kind of a good discussion of how those of us that focus on the financial industry, we tend to be early with some of the things that we're a bit worried about. And everybody needs to be aware of concerns for them to start to hit the market. And I think we're getting closer to that with respect to private credit now than we were in the past. I'm actually going to show how I personally try to get an idea as to whether or not a topic is out there amongst the masses or only being paid attention to by those of us that like to talk about the day-to-day odds on the next Fed cut and things like that. Some of
Right.
us, yep.
No, I just said, right. I agree with you.
So
Yeah.
we're going to start out. I'm just going to explain what the private credit market is, what it came out of, which is kind of funny, who the participants are on both sides. And then, as we mentioned, there are some concerns jumping into the marketplace now. I'm going to address those, and then I'm going to put my own little spin on it as to whether or not the concerns are justified that we're getting ready to get our next volatility event out of the private credit market. I'm not even going to hint as to what our thinking is on that one yet. So the private credit market, it's basically non-bank companies lending to institutional entities through private placements. And this was partly a result of some changes that came about after the great financial crisis. Now, the great financial crisis was in 2008. The private credit market was in its infancy in 2000. In fact, I was at a hedge fund in the late 90s, and I remember being approached about possibly placing some of our capital in private credit or even starting a private credit fund, something we chose to pass on. I don't know if that was a good idea or a bad idea. I think it's worked for some folks and not worked for others. It has grown into a massive market. $2.5 to $3 trillion as of early 2025. I think that's from a Morgan Stanley report. It's very difficult to get exact numbers on this market because it's private and non-transparent. And as I mentioned, it's kind of flown under the radar until the past few months. With a lot of folks in the financial industry aware of it, aware of its growth, but not necessarily aware of the dangers around it. Yes, ma'am.
I have a question for our number one fan.
Uh huh.
So, when you say that it's private, how do people trade private transactions then?
Well, in this case, it would be an entity looking to borrow money that probably can't issue bonds, but needs credit for day-to-day operations, needs credit for expansion, maybe even needs short-term credit
Hmm.
while they're completing some sort of acquisition, et cetera. But there are entities like, and I think Apollo is the biggest one out there, but there are entities that run private credit funds like a more like, because they're private investments, although there are some public ones now, but they run these funds, they have capital, and they will do a little due diligence and lend to entities at a above market interest rate, which is something we need to keep in mind here. And often at a floating interest rate, which creates some dangers in its own right.
Wait. So what's the difference between a floating and a non-floating rate?
Well, if I were to take let's say I take a car loan out, if I'd say I want a fixed rate loan, maybe they're going to charge me 6 or 7%, and that number's never going to change. If and it's not as common in the U.S. as other parts of the world to have floating rate exposure. It's just something that seems to be a bit more European oriented than U.S. oriented. But if I thought interest rates were going to start going down, I might say, well, I would like a floating rate loan because I think that the interest applied to my loan is going to go down over time. And typically, a floating rate loan, historically, they would be tied to the LIBOR rate. So if LIBOR, it'd be LIBOR plus 3% or something like that. Now it's the secured overnight financing rate. So if I think that the Fed's going to aggressively cut rates over the next couple of years and I need to borrow money and I have the ability to get a floating rate, I would ask for a floating rate because I think rates are going to go lower. In the private credit space, I think that you have to take out a loan with a floating rate because the entity that is lending to you wants to offset their interest rate risk. And that's the way that they go about offsetting their interest rate risk. So I mentioned that this has mostly flown under the radar for the past few months. And this is exactly what I do when I'm trying to get a handle on, what does the average public know relative to what I think is going on in the markets? And Google Trends is great. You just type Google Trends in the search bar and you get this. I typed in private credit and I asked for the end of month starting. It actually gave me data going back to the year 2000, which the number was very close to zero. But as people have become more interested in the market, as it's become a larger part of the financial markets, you can see that the rating went all the way up to the 20 to 100. I think that was January or February this year, and that's when a couple of private credit funds announced that they were having issues. There's some private credit funds that are also announcing that they are limiting investor withdrawals, which means that they are not seeing the kind of repayments that they were hoping to see. So that the Google Trends history on this is not people searching because they want to take out a private loan. It's because they're hearing their problems with the private credit market. And it hasn't necessarily worked its way through to the financial markets yet, but it is definitely on people's radar now, and it wasn't 18 months, 2 years ago, for sure. So I just wanted to give a little overview as to what the difference between the two, between issuing a bond, which is what companies that are borrowing money would prefer to do. It's less expensive. They tend to, if they have the ability to issue bonds, they probably are going to be able to borrow at a lower interest rate than if they have to go through the private credit or private loan route. The bonds are publicly traded. If I'm Ford Motor, I have a pretty good idea as to what interest rate I would have to pay if I issue more bonds, because I can take a look at what my current bonds are being valued at. Private loans are not publicly traded. If you're stuck in a bond and you're not very happy about the company that represents the bond, you can sell that bond. Getting out of a private loan is a bit more tricky, and pretty much you're stuck until the entity that is paying you has fully paid you back.
Yeah,
it's very difficult to transfer that risk. There's no liquidity whatsoever in the private loan market. Bonds, I originally typed liquid there, and then I caught myself because I mentioned Ford Motor. Ford's got dozens of bonds outstanding. Only a handful of them trade each day. The rest of them They're not people interested in transacting them, et cetera. So I don't want to say the bond market is liquid and then have somebody buy a corporate bond and then go, oh my goodness, the bid-ask spread is, this wide. It's wider than
Right.
the screen. It's dependent. The government bond market is extremely liquid. The
Yes.
coupons for private loans are typically floating, which, and I mentioned the secured overnight financing rate. Typically, it would be whatever SOFR happens to be right now, plus 2, 3, 4%. And that is how the lender is guarding against rising interest rates. It's very often in the private loan market that the entity making the private loan might be borrowing at a lower rate from a large institution and then turning around and lending at even higher rate, which is what banks used to do on a traditional basis. They would make, they'd make auto loans at 5 or 6%, and they may borrow money from the government by buying government bonds at 3 or 4% and make money off of that spread. The coupon on bonds is typically fixed, whereas the private loan, it's usually, like I said, it's usually a floating rate, which if you're an investor and you think that the entities that are borrowing from your private loan fund are going to continue to make all of their payments even in a higher interest rate environment, you could think of private loans as being a bit less risky in this aspect than regular bond, than the traditional corporate bond market. So there is one advantage there to investing in private loans, and it is higher returns. But what are higher returns always married to?
Higher risk.
There you go. Look at that. We're like a well-oiled machine today. So the lenders, a lot of private equity funds have gotten involved in this. I even know of a private equity fund that likes to lend money to companies they think are going to go bankrupt. And what they want to do is they want to take that firm's assets.
Got it.
We have a private equity individual that comes to speak at Kelly every year, and that's exactly what his firm does. And it's really neat to hear him talk about we buy up all of their debt when we think they're in a distressed situation, and we pay a lot less for the debt than what we think the assets are worth to us. And you can go down a long rabbit hole on that one. There's specialty lenders that are involved in this market. Insurance companies, I probably should have put them up at the top, but they're always looking for interest-bearing, investments. And so insurance companies, through private credit firms, I think have become more and more involved in this. And asset managers, they may, instead of allocating money to high yield bonds, they may allocate cash to private lending funds. They kind of have the same risk profile. And in fact, I didn't include it here, but the high yield bond market has not been growing as fast as the corporate bond market. But if you include private credit and say that's actually high yield lending, it actually is going up in line. So I think a lot of the high yield bonds that used to be issued are now being issued, or those entities are borrowing from private lenders as opposed to issuing bonds. The borrowers, small public companies, firms owned by private equity investors, if they need more capital, but they don't want to issue more ownership, they may, much like if a company has shares outstanding and they need some extra capital, if they have the ability, they would rather issue bonds than issue more shares. Same thing with VC backed firms. And then real estate and infrastructure projects. And when I get to the industry breakdown, you're going to see real estate is at the very bottom. But I think the real estate infrastructure projects are being done by the top of the industries that are involved in this. And that's what we're looking at right here. The software and technology, that's AI data centers.
Okay.
That really, they're more, in fact, we're talking on March 16th, 2026, and I'm throwing that date out there to give some perspective. Over the weekend, Facebook/Meta announced they're probably going to have to fire 20% of their employees because they need that capital to build out their AI. So they're all looking for capital everywhere. And I think that's why software and technology is 20% of the, of this. And then the pharmaceutical part, it's more startup biotechs
Yep.
than Eli Lilly or
Right.
companies like that. And you can see we go all the way down. At the very bottom is real estate. So you saw real estate a slide before, but it's real estate investments from these different industries. And I like how spread out this is. In fact, before I dug these numbers out from a couple of sources and kind of averaged them, I was expecting I wasn't expecting tech to be so high up. I was expecting
I can
manufacturing
see
and
that.
industrials a bit more, like small
Mhm.
manufacturing firms, and financial services. I expected that to be a bit higher because natural resources and energy, the prices, that I felt like natural resources, not necessarily energy, maybe in the rare earths area, because that's a big capital investment to get that running. I thought that might be a little bit higher up the list as well, but that's why you do the research and don't make the assumptions. Where am I going here? Oh, yeah. And all of these headlines are within, again, I mentioned it's March 16th, 2026. All four of these headlines are within the last 3 days leading up to. And I had, Dr. Ademiak knows I have some short-term memory issues every once in a while. I had forgotten that we did a video on is private credit, is it appropriate for individuals? And we said no.
Yeah.
So, and I've never been a fan of people that say, I told you the market was going to crash and take those big victory laps, but I'm going to take a small victory lap and include a link to that video below this. And I didn't say it was going to crash. I didn't say that this poor guy in the blue box was going to lose everything, but it was something that was starting to pop up on our radar screen. And one of the reasons that it did was they were starting to offer exposure to private credit to individuals. Well, if private credit is so freaking good as an investment, institutions are not going to offer individuals the ability to get involved in it. That's often a red flag. And you can see this that 265 billion private credit meltdown. That's from Fortune. Benzinga noted that Morgan Stanley and BlackRock were limiting withdrawals from private credit. A lot of private credit firms are doing that. In fact, Blue Owl is in a lot of trouble. They're kind of the poster child for what's wrong with private credit right now. I thought it was kind of funny that over the weekend, as I was flipping back and forth between the Purdue Michigan game, go Boilermakers, and the golf tournament, there were 2 or 3 of the leaders in the golf tournament that had Blue Owl emblems on their shirt. They may want to find another sponsor now.
They might want a new one. Yep.
So with that, oh no, I'm not done. I thought I was almost done. I've kind of hit on this a bit. There are concerns in the marketplace, and justifiably so. I mean, we've got the commonality that just about any financial crisis that we've had has been, or issue within the financial markets, has often been a result of non-banks getting involved in traditional banking areas. And that's what we're looking at right now. In the 90s, we actually had a lot of subprime auto lenders go bankrupt because they were giving auto loans to individuals that couldn't get their auto loans from banks. We saw the same thing with the great financial crisis in the housing. So many of these have started to, many of the firms with exposure to these types of loans have started to see some issues with the repayments. They started to share that they're seeing issues with these repayments. They're limiting withdrawal from those funds. One of the big canaries in the coal mine in 2008 that I think we talked about on our last video was that money market funds were suddenly going to limit how much capital you could take out of a money market fund,
Right.
which was very worrisome. So there are some similarities here. I know Dr. Demiak does not agree with me on it's not as much of as concerning, which is totally fine. I'm going to go why I don't think that is, and then we're going to debate. Okay. All
Mhm.
right. No, I'm just setting it
Oh,
up.
no, yeah, yeah.
Yeah.
You're going to talk about why it's not a 2008. Okay.
Yeah, I'm going to say that, and then you're going to say why you do think it's a 2008, which I think is great. I like that. One issue here was just market size, and the mortgage-backed market was about 9 trillion at its peak, and that's about 3 times where we think private lending is. Private lending is growing, and I did see an estimate that it should more than double between now and 2030 if it keeps going at the same pace. I'm not sure if that's going to happen. Um, Also, one of the things that I like to do, you'll see somebody talk about who's the highest paid athlete in history, Dr. Ademiak. It's some chariot
That
rider.
would be maybe
It's
Michael Jordan.
No, it's a chariot rider back in Roman times. You know that. I showed you that list. And
I know.
what they did was they came up with an inflation adjusted figure to his all-time earnings, and it came to 150 billion, which but
Michael will never get to.
yeah, he'll never. But I'm talking about, you talk about inflation adjusted numbers. Well, when people talk about something that's going on in the financial markets and, is this a repeat of 2008? Well, I want to look at the size of that market relative to the financial markets. And the mortgage-backed securities market was about 9 trillion, and the S&P 500 at the beginning of 2008 was around 14 trillion. It's closer to 50 trillion, 45 to 50 trillion today, depending on where we are day to day. So as a percentage of the equity markets, the private lending market is not quite there. And then I do like some of the diversity that we get in industry exposure for the lenders versus it was all real estate basically in
Mhm.
2008, although it bled out elsewhere. So
So
and you believe there are some systemic issues, and I'm going to sip
I
something and
do.
listen.
I really do think there's some systemic issues. I believe that this is going to mirror more like the dot-com bubble, where we had these mini events, so to
Uh-huh.
speak, and these mini crises that are going to happen across the board. And I love your example, your metaphor of the canary and the coal mine,
Mm-hmm.
because there are several different canaries here, and they're going to start dropping. And as soon as you get to a significant number of canaries that have dropped, I think then we'll start to see a major sell-off in the market.
Mm-hmm.
So we're starting to see this in private equity. And we're starting to see this in insurance being overvalued. We know that asset prices are still very high.
Mm-hmm.
We're still struggling for people to be able to pay back some of those their what they own in credit cards and auto loans. So I think we're going to start to see not the catastrophic drop that we saw in 2008, but these small entities, and it will, because what we dropped 78% in the dot-com bubble over
Yeah,
the
the
2 years.
Nasdaq did. Yeah.
But it took 2 years for us to hit that low. And
Mm-hmm.
it took 15, 16 years to build back. And my thought is with the systemic risk is that we're going to start to see it in private credit, and then it's going to pop up somewhere else. And it'll hit a different subset of the market. It'll hit a different subset of investors.
Mm-hmm.
And this will continue happening as the market begins to correct itself for its overvaluation in different assets. I suspect that insurance might be next, especially since insurance and private equity are so closely tied to each other.
Yeah.
And I believe that these are definitely things that are going to could become a catalyst for other things.
I I think it could be a catalyst where the planned AI spending gets scaled back because the access to capital starts to dry up.
Right.
And also my big concern about the private credit markets. Remember, these things are floating rate, and there has been the expectation of a rate cut in 2026 is almost gone away. We're down to the market pricing in one in the fall, maybe. And that's a result. That's just we're going to have some inflationary concerns because what's going on in the Middle East is going to bleed through with respect to inflation, et cetera. So that's I worry a bit about there we are worry a bit about that aspect as it works its way through a few industries that have been dependent on massive spending and borrowing to make that massive spending.
Right. And AI has been very dependent on massive spending.
Oh, absolutely. So and seeing that 20% of this market, that was a real red flag to me
It's a
when I saw
shocker.
that. Yeah, when I saw that 20% is in the software technology, I really thought it would be more of because a lot of people don't realize that a big portion of private equity is like small manufacturing firms, and the high, the ones everybody gets excited about are technology firms. But there are a lot of mid-sized businesses that are backed by private equity that have nothing to do with technology and are
Sure.
nice solid companies. Uh, I just assumed that was a big portion of the private credit market as well, and seeing technology at the top of the list, that's a bit worrisome because the amount of money that's being spent on AI right now, I think it's difficult to justify, and with respect to how much cash is going to be generated by AI to help pay those bills. And as people realize that, I think they're going to be a little bit less willing to lend money to build out giant AI data centers, et cetera.
And the AI will negatively impact those mid-sized manufacturing firms that you were just discussing because it'll
Yep.
be harder to get the private credit because of the negative impact of the AI private credit loans and borrowings.
Yeah.
So and this is where I think that it is a little more systemic than perhaps you do, because I think we'll start to see it bleed into other different
Mm-hmm.
aspects of the markets.
It's nobody's ready for higher rates. There's
No.
just no question in my mind. So, all right. Everybody likes you better, so you can take us home.
Well, if you like this video, please hit like. And if you are not already a subscriber, please go ahead and subscribe. Also, we are very open to constructive criticism. If there is a topic that you'd like to see, we are happy to deliver it because, well, we actually like doing this. So with that, we do thank all of you for hanging with us, and we look forward to seeing you next time. Thank you.
Thank you.